Meanwhile, the International Monetary Fund says interest rates will likely return toward pre-pandemic levels when inflation is tamed. Global interest rates have rapidly increased recently as monetary policy has tightened in response to higher inflation. While here at home, the Reserve Bank also raised interest rates since October of 2021. This comes as inflation spiked, reaching levels above the central bank's target bracket of 3 to 6%. The IMF says that the inflation is brought back under control. Central banks are likely to ease monetary policy and bring real interest rates back towards pre-pandemic levels. Inflation in South Africa is expected to average 6% this year. The repo rate is at 7.75%, whilst the prime lending rate stands at 11.25%.
Inflation does play a big role in emerging and developing economies. I think we are very clear in the chapters to say that this does not imply that inflation is a desirable tool. That is not an implication of the chapter at all. And because we all know, what the consequences of high inflation can be, especially from point of view of sovereign debt, it can lead to losses on the balance sheets of sovereign debt holders, and and more importantly, dent to credibility. I think both Joe and Olivier probably referred to, theoretically, the impact of inflation depends on whether it's expected or unexpected. And if it's expected, the idea is that, theoretically, nominal interest rates could go up, and that could offset some of the impact on the denominator of debt to GDP. In practice, and let me just point out two things, we still find that nominal interest rates are way low in emerging and developing economies, and that could be either due to concessional financing or due to financial repression in EMs. But we also have a box, which is box 3.2, which shows, and it's in line with Joe's conjecture that nominal interest rates actually feed very slowly into the effective interest rates on debt. And this could be because, on average, I think the maturities are still very long.